Welcome back. You're still tuned into First Rates right here on ET Now, and the fourth quarter of FY25 earnings season just concluded. And it was rather a strong quarter. Several sectors, metals, oil marketing companies, IT, auto sector, all of them reported better than expected set of numbers. But what does this mean for earnings for the rest of the year? To discuss exactly that, we now have Mr. Vinod Karki, Head of Strategy at ICICI Securities, now joining us. Mr. Karki, thank you so much for taking your time out and joining us here on ET Now. What is your view on how the earnings season panned out, the fourth quarter FY25, and what does this mean for the rest of the year? And any specific sectors that you are looking at after the result season?
Yeah, good morning and thank you for having me on the show. First of all, if you look at earnings, there are three ways to slice and dice it. One is the aggregate corporate profitability itself. So if you look at FY25 itself, one remarkable thing that happened in FY25 was that the losses or the loss pool of the loss-making companies that went to the cycle low of around 0.27% of GDP. And in absolute term, this was the first time after FY14, from where this earnings recession happened, that the losses shrunk below 1 trillion in aggregate. So that was one. And we know that the GDP expanded by around 9.8% for FY25. And the overall corporate profit expanded by 10.7%. So slightly it went ahead of the nominal GDP. And reached that level of 5.1% of GDP. So that's the aggregate. Now the second thing is to look at what was the market expecting and how the results came in. So apparently in Q4 the market went into the results with low expectations. So overall we saw more beats coming in than the misses. That kind of a thing. And thirdly, you have to look at the growth itself in the Q4. So if you look at the growth, what we saw is that the operating profit growth stood at around 12%. And now that is ahead of the nominal GDP that we saw for Q4 itself. But when it came to the PAT level, it dropped off to around 6-7%. Now I think that is to do with we saw one-offs for a lot of companies, which resulted in the net profit level growing at a lower pace than the operating profit. And the last, but not the least, is how the street is looking at earnings after the result. So what we have seen is, on an average, for the wherever the data is available for consensus, the average downgrade for 26 and 27 has been limited to around 2.5%. So that's in a nutshell, but just to give one data point, if you look at where the largely the disappointments have been across these factors, one is on actual growth, the outlook and downgrades. Distinctly, we saw some of the FMCG and IT where growth expectation and actual growth, everything was, and outlook was also not looking too good. So I think defensives in general, just to put it in perspective, I think was lagging as compared to the cyclical sectors, be it the real estate, capital goods, hotels, travel, industrials, defense, all these. Now the banks also, if you see after this whole this stimulus by the RBI, I think they are also looking ahead for good credit growth. So so I think the cyclical sectors in the economy appear to be doing well. In a nutshell.
Point taken. This is Snehi also joining in. You did talk to us about the defensives and the kind of earnings that we've seen there. But what about your view on any hits or misses, any surprises or disappointments that you've seen? Because like you said, we were anyway expecting muted set of numbers. Our expectations were rather muted, but these numbers have been a beat on the back of that. So anything that stood out to you in terms of a good surprise or a disappointment, and your overall outlook on what stood out and if this merits a re-rating in your portfolio?
Yeah, so I think, as I said, there were, the expectations were lower. So that's why we got more beats overall. But what was remarkably weaker in terms of outlook, we saw from some of the larger IT companies and some of the large staples companies in terms of the growth outlook. It was looking pretty muted, weak, that kind of a thing. And obviously, what has also happened is that a lot of uncertainty from the global angle. So any company which is catering to the global demand, because of this whole tariff issues and all that, the outlook is getting a little uncertain in that way. So there is a bit of uncertainty on globally exposed demand companies, be it even pharma to some extent. So anything to do with global demand and some of these defensive sectors, I think that is where we saw clear, what I should say, misses. But on the cyclical sectors like industrials, commodities, real estate, travel, tourism, all those kind of cyclical sectors, auto, we saw sparks of performance over there.
And since you spoke about cyclical sectors in particular and especially commodities, metals numbers were largely in line with what the street was working with. Of course, slightly better, especially with companies like Tata Steel reporting cost reduction programs. How do you see the metal sector as a whole, given what's happening in China and globally, and also your thoughts on oil marketing companies? We've seen a lot of volatility around oil prices. How do you see this impacting oil marketing companies and oil marketing companies for the rest of the year?
Yeah, so let me put this in perspective. See, the biggest drag in FY25 earnings, if you look closely, was driven by commodities, which include cement, which includes oil marketing companies, which include metals in general. What we are seeing is that this pressure of commodities on overall aggregate earnings, that has started to recede, and these companies are giving better outlooks. The growth itself is better, So I think, and with crude prices not spiking the way they were earlier in the year when Trump came to power, I think that will allow the government to be more, conducive to the whole oil marketing company outlook. And metals will have the metals is a global commodity, so it will be an interplay of how domestic demand plays out, what kind of safeguards we have for protecting the domestic producers, what China does in terms of dumping, and all those things are there. But cement, for example, is another commodity, but then it's not impacted by it's not a global commodity. So there things are much better, So, but the key thing to look out is that if you look at the expectations, the consensus, the commodities are coming out of a phase where they were a drag on earnings and started to contribute to earnings. So that's the key takeaway from this earnings season.
Karki, appreciate you joining us on the show today. Thanks so much for joining us, and we'll reconnect with you next quarter as well, hopefully.
Sure.
Well, on that note, we'll slip into a very short break on this